Before we begin, it is crucial to understand that the information in this video is for educational and informational purposes only. It does not constitute and should not be taken as financial, legal, or tax advice. The life insurance claim process can be complex and varies based on state laws, policy terms, and individual circumstances. For guidance tailored to your specific situation, you must consult with a qualified financial advisor, an attorney, or other licensed professionals. Imagine this for a moment. The worst has happened. You've lost someone you love, and your world has been turned completely upside down. Amid the grief, the phone calls, and the endless crushing weight of it all, you remember something. Promise. A life insurance policy. It's supposed to be a safety net, a final act of love designed to protect you and your family from financial ruin. So you pick up the phone, you find the paperwork, you start the process, and you hit a wall of confusing jargon, endless forms, and a sense of absolute dread that you're going to do something wrong. This is the hidden nightmare that millions of American families face every single year. They're handed a potential lifeline, but it's tangled in so much red tape and corporate procedure that they feel powerless. They're afraid of making one tiny mistake on a form that could delay a critical payout for months, or even worse, lead to an outright denial. Let me be clear. The single most stressful financial task a person can undertake is filing a life insurance claim while grieving. And most people are forced to do it with zero preparation and no guide. That ends today. This video is that guide. This is your step-by-step roadmap through the entire life insurance claim process in the United States. We are going to demystify every single step. We will translate the insurance jargon into plain English. We will show you exactly what documents you need, how to get them, how to fill out the forms correctly, and what to expect from the insurance company from the first phone call to the moment the check is in your hand. My goal is to take this overwhelming, confusing process and make it clear, manageable, and something you can face with confidence. We are going to turn that feeling of powerlessness into a feeling of control, right when you need it most. So let's start at the very beginning. The first and sometimes the hardest step: locating the actual life insurance policy. You can't claim a benefit you can't prove exists. This might sound simple, but in the chaos following a death, critical documents can be hard to find. The person who passed away might have been incredibly organized, with a folder clearly labeled life insurance. If that's you, count yourself incredibly lucky. For everyone else, we need to do some detective work. First, start with the physical search. You're looking for a document that is officially called a policy. It might be a single sheet, or it could be a booklet of 20 pages. Look in the most logical places: a home office, a file cabinet, a desk, or a safe deposit box. Check folders labeled insurance, finances, legal, or even just important papers. Don't forget to look through old mail. Insurance companies send annual statements, premium notices, and privacy policy updates. Finding any piece of mail from an insurance company is a major clue. It will have the company's name and, most importantly, a policy number. That number is your golden ticket. Write it down immediately. If the physical search comes up empty, it's time to go digital. Check the deceased's computer, specifically their email. Search their inbox and archive folders for the names of major insurance companies. Think Prudential, MetLife, Northwestern Mutual, New York Life, and so on. Also, search for terms like life insurance, policy, premium, and beneficiary. They may have received digital copies of their policy or annual statements via email. While you're on their computer, check their online banking records. Look through bank statements for automatic payments or checks made out to an insurance company. This is one of the most effective ways to find a policy. A recurring payment every month, quarter, or year is a huge red flag that a policy is active. The transaction details will name the insurance company. What if you've done all that and still have nothing? Don't panic. The next step is to contact the professionals in their life. Did they have a financial advisor, an insurance agent, or an accountant? These professionals often keep records of the policies their clients own. An insurance agent who sold them their car or home insurance might also know about a life insurance policy, even if they didn't sell it themselves. They often do a full financial review for their clients. Similarly, contact their employer or former employer if they were retired. Many people get life insurance through their job. This is called a group life insurance policy. The Human Resources Department is the place to start. They can tell you if the person was enrolled in a group plan and who the insurance carrier is. Be aware that for many, this coverage ends when they leave the job, but not always. Some policies can be converted into an individual policy, So it's always worth asking HR. Now, let's say you've tried all of that and you still have a strong feeling a policy exists but you just can't find it. There are a few more advanced tools you can use. The National Association of Insurance Commissioners, or NAIC, has a free tool on their website called the Life Insurance Policy Locator Service. You can submit a request, and they will ask participating companies across the country to search their records for a policy in the deceased's name. It's not instantaneous and not every company participates, but it has connected thousands of people with lost benefits. Another route is to check state-specific resources. Many states have an unclaimed property database. If a life insurance company knows a policyholder has died, but can't find the beneficiary after a certain number of years, they are legally required to turn that money over to the state. You can search these databases for free online using the deceased's name. Finally, there's a service called MIB, formerly the Medical Information Bureau. While their main purpose is to prevent fraud, they maintain a database of life insurance applications. For a fee, an executor or administrator of an estate can request a search of their records to see if the deceased had applied for a policy in the last several years. This won't tell you if the policy was approved or is still active, but it can give you the name of the company they applied with, which is a powerful lead to follow up on. I know this sounds like a lot. It is. It's a frustrating scavenger hunt at the worst possible time. But finding that policy document, or at the very least the policy number and the name of the insurance company, is the non-negotiable first step. It's the key that starts the entire process. Take a deep breath. Go through these steps one by one. Be methodical. Ask for help from family members to search. Once you have that policy in your hands, you've conquered the first major hurdle. You've proven the promise exists. The next step is to gather the official documents you'll need to formally stake your claim, starting with the single most important document of all, the certified death certificate. This document isn't just a piece of paper. It's the official government-sanctioned proof that the event triggering the policy has occurred. And let's be crystal clear about one thing, because this is the first tripwire many people hit. You need a certified death certificate. Not a photocopy. Not a scan you printed out. A certified copy. What's the difference? A certified copy is a legal document issued by a government authority, like the county or state's vital records office. It will have a raised, embossed seal, a watermark, or some other official marking that proves its authenticity. An insurance company will not, under almost any circumstance, accept a simple photocopy. Why? Because their entire business model rests on paying out legitimate claims and preventing fraud. A certified death certificate is their gold standard of proof. It's the legal key that starts the engine of the entire claims process. So, how do you get them? The funeral home handling the arrangements is almost always the easiest and fastest source. They are accustomed to this process and typically order multiple copies for the family as part of their services. If you're handling this yourself, you'll need to contact the Vital Records office in the county where the death occurred. You'll have to prove your relationship to the deceased, fill out a form, and pay a fee for each copy. And here is perhaps the most important piece of practical advice I can give you at this stage. Order more copies than you think you need. Order 5. Order 10. You might think you only need one for the life insurance company, but you're about to discover that everyone wants one. The bank will want one to close an account. The Social Security Administration will need one. Credit card companies, mortgage lenders, the DMV, pension administrators, the list goes on and on. Each certified copy costs money, yes, but ordering them all at once is infinitely easier and cheaper than having to go back and request more, one at a time, weeks or months later. Think of these certificates as your master keys to unlocking and settling the deceased's financial life. You need a key for every single lock. Once you have your stack of certified death certificates, you have the cornerstone of your claim. But it's just the first piece of the puzzle. The next document you need is the one that formally puts the insurance company on notice. This is the claimant's statement, more commonly known as the claim form. This is your official application for the death benefit. It's the document where you formally identify yourself as the beneficiary, provide your information, and attest to the facts of the death. Getting this form is your next mission. You can typically find it on the insurance company's website, often in a claims or forms section. If you can't find it there, you can call the company's customer service line and ask them to mail or email it to you. If you are working with a local insurance agent, they can be an invaluable resource here, providing you with the correct form and guiding you on what's needed. Do not underestimate the importance of this form. It might look like just another piece of administrative paperwork, but every single box you check, Every line you fill in becomes part of the official record of your claim. We're going to dedicate a whole future part of this series to filling out this form with surgical precision, because this is where innocent mistakes can cause catastrophic delays. For now, your only job is to get your hands on the correct, most up-to-date version of the form. Print it out or save it to your computer. Read it over once just to familiarize yourself with what it's asking for, but don't fill it out just yet. We need to gather the rest of our evidence first. With the death certificate and the blank claim form in hand, you've got the two main pillars of your submission. But the company also needs to verify who you are. They have a contractual obligation to pay the benefit to the correct person named in the policy. They need to be absolutely certain that you are, in fact, Jane Doe, the listed beneficiary. So, the third document you'll need is a clear and valid copy of your own government-issued photo identification. A driver's license is the most common. A state-issued ID card or a U.S. passport also works perfectly. Just make sure it's not expired. This is a simple but non-negotiable step. It protects you and it protects the insurance company. Now there's one more document that can be incredibly helpful, though it's not always a deal-breaker if you don't have it. That is the original life insurance policy document itself. This is the physical paper contract that was issued when the policy was first taken out. It spells out all the terms, the coverage amount, the policy number, and the named beneficiaries. If you can find this document among your loved one's important papers, fantastic. It can significantly speed up the process because it gives the claims processor the exact policy number and details they need right at their fingertips, eliminating any potential for looking up the wrong person or policy. Make a copy of the entire document for your records, and prepare to send the original if the company requests it. Though many now only require a copy. But what if you can't find it? What if you know a policy exists but the paperwork is nowhere to be found? First, don't panic. This is an incredibly common situation. A lost policy document does not mean the policy is void. The insurance company is the ultimate source of truth. They have the master records. As long as you have the deceased's full name, date of birth, and ideally their social security number, the insurance company can locate the policy in their system. The search we discussed in the first part of this series, checking bank statements for premium payments, becomes even more critical here, as those statements will name the insurance company and often even list the policy number, giving you exactly what you need to get the process started. So, having the policy is good. It's a shortcut, but not having it is just a detour, not a dead end. So let's recap our mission for this stage. You have assembled your claim dossier. You have the official certified death certificate, the undeniable proof. You have the company's official claim form, the vessel for your request. You have your own photo ID, the proof of your identity as the rightful claimant. And hopefully, you have the original policy document, the blueprint of the promise. You are now standing at the door. You've gathered the key, you found the map, and you understand the basic layout of the castle. You have successfully transitioned from a state of shock and uncertainty to a position of organized readiness. You have everything you need to formally and officially demand that the promise made years ago is now honored. But gathering the documents is one thing. Presenting them correctly is another. The next step is the most critical and detail-oriented part of this entire journey. We must now take that blank claim form, that simple-looking piece of paper, and fill it out. It seems straightforward, but this form is a minefield of potential errors. A wrong date, a misunderstood question, a checked box that contradicts other information. Any tiny mistake can send your claim into a pending status for weeks, or even trigger a full-blown investigation. This is where your claim can either sail through smoothly or get stuck in a frustrating administrative limbo. And we are going to make sure it sails. The next step is to master the claim form itself. The claim form is not just a piece of paper. Think of it as the final exam. It's the last hurdle standing between you and the financial security your loved one intended for you. It looks simple, maybe a few pages long, but every single box, every line was designed by teams of lawyers and actuaries. Every question is there for a reason, and that reason is to verify the legitimacy of the claim and protect the insurance company from fraud. Your job is to give them zero reason to pause, to question, or to deny. Let's break it down section by section. The first part is usually the easiest, but it's also where the most frustrating and frankly dumbest mistakes are made. This is the basic information. The deceased's full name, their policy number, your name, your address, your social security number. Seems like a no-brainer. But in the fog of grief, it is shockingly easy to transpose two numbers in a policy number, or to misspell a middle name. A single typo here doesn't invalidate your claim, but it sends it right to the back of the line. Your pristine, ready-to-be-paid claim gets kicked into a pending information queue, where it can sit for days or weeks until someone has time to call you and ask, "Did you mean a 7 or a 1? Get a fresh pair of eyes to look it over. Read every number and letter out loud. This isn't just data entry. It's the foundation of your entire claim. Get it 100% right." Next, you'll come to the section that is often the most emotionally difficult to fill out. This is the specific information about the death itself. Date of death, place of death, and the cause of death. You might be tempted to write something simple like heart failure or car accident. This is where you need to be precise. You are not the one determining the cause of death. The official death certificate is. Your job is to copy the exact clinical wording from that certified document onto this form. Don't editorialize. Don't add your own theories or details. If the death certificate says myocardial infarction, you write myocardial infarction. If it says blunt force trauma, you write that. Why is this so critical? Because of something called the contestability period. In nearly every state, a life insurance policy has a 2-year window from the day it starts. If the insured person passes away from non-accidental causes within that 2-year window, the insurance company has the right to launch a full investigation into the original application. They will pull medical records, doctor's notes, everything. They are looking for something called material misrepresentation. Did your loved one forget to mention they were a smoker? Did they downplay a pre-existing condition? If the cause of death you write on the form even hints at something that might contradict the original application, it raises an immediate red flag. For instance, if the cause of death is complications from diabetes, and the application from 18 months ago has the "Are you diabetic?" box checked no, you're headed for a long, difficult investigation. By simply transcribing the exact legal cause of death from the certificate, you are providing a fact, not an interpretation, and giving the claims examiner a clean, verifiable piece of data that matches the official record they are about to receive. Speaking of that official record, the next section of the form is essentially a checklist of the evidence you need to provide. The number 1 item on this list, the absolute non-negotiable, is a certified copy of the death certificate. Not a photocopy, not a scan. A certified copy, issued by the state or county vital records office, usually with a raised seal or special watermark. When you order these, get more than you think you'll need. You might need them for banks, for the DMV, for credit card companies. Order at least 5, maybe even 10. It's far easier to get them all at once than to go back and request more later. The form might also ask for other documents depending on the circumstances. If the death was accidental, they will almost certainly require a copy of the police report or the coroner's report. If the beneficiary is a trust, you'll need to provide the relevant pages of the trust document that identify the trustee. Gather everything on that checklist before you even think about sending the packet in. Sending an incomplete claim is like trying to board a plane with only half a ticket. Simply not going to fly. Now we get to the final and perhaps most important section of the claim form, the payout options. This is where you decide how you want to receive the money. For many, this feels like the light at the end of the tunnel, and the temptation is to just check the first box and get it over with. Please do not do this. This decision has major financial implications. You'll typically see 3 main choices. The first is a lump sum payment. This is usually the most straightforward. The insurance company cuts you a check or makes a direct deposit for the full death benefit. For a $100,000 policy, you get $100,000. It's clean, it's simple, and the money is yours to control completely. The second option, and one you need to be extremely wary of, is something called a retained asset account, or RAA. The insurance company will frame this as a convenient service. Instead of sending you a huge check, they'll open a special interest-bearing account for you and send you what looks like a checkbook. You can then write checks from this account to pay bills or transfer money as you need it. It sounds great, but here's the catch. That money is not in a real bank account. It is still being held by the insurance company. It is not FDIC insured, which means if that insurance company were to fail, your money could be at risk. The interest rates they pay on these accounts are also typically far lower than what you could get in a high-yield savings account or a simple money market fund. The insurance company is essentially borrowing your money back from you at a very low rate. They are making money off of your money while it sits in their account. The third option is an annuity or installment plan. Here, the company pays you the benefit over a set period of time, say 10 years or for the rest of your life. This can be a good option for people who are worried about managing a large sum of money, but it's a complex financial product. You're locking yourself into a long-term contract with the insurer, and the total amount you receive might depend on interest rates and how long you live. So what's the right choice? For the vast majority of people, the lump sum is the safest, most flexible, and most transparent option. Take the full amount. Immediately deposit it into your own, FDIC-insured bank account. This puts you in control. It separates you from the life insurance company. Their job is done. From there you can take a breath, and with the help of a trusted financial advisor, one that you choose, not one recommended by the insurance company, you can decide how to best use those funds to secure your future. You've now meticulously filled out the form. Every number is correct, every statement is factual, and you've made a smart decision about how you want to be paid. You've assembled your certified death certificate and any other required reports. The package is sealed and ready, but your work isn't quite done. How you physically send this package, who you confirm its receipt with, and the paper trail you create in the process is the final critical piece of the puzzle. This step can mean the difference between a check arriving in 2 weeks and you having to hire a lawyer in 2 years. And there's one common mistake people make right at this stage that can render all your hard work useless. That mistake is choosing the wrong payment option on the claim form itself. Sounds so simple, so administrative, but this single checkbox is where grieving, overwhelmed beneficiaries can lose tens of thousands of dollars, or even lock their money away for years without realizing it. The insurance company isn't your friend here. They are a business, and the claim form is designed subtly to serve their interests first. Your job is to make it serve yours. So let's break this down. You've got the death certificate. You've got the claim forms. You sit down at your kitchen table, pen in hand, and you start filling it out. The first parts are straightforward. The deceased's name, their policy number, their date of birth, date of death. Then it asks for your information as the beneficiary. Your name, your address, your social security number. You need to be meticulous here. A single digit off on a social security number can send the whole process into a bureaucratic black hole for months. Double check it, then triple check it. Have a friend or family member look at it with a fresh pair of eyes. You are emotionally compromised right now, and simple mistakes are easy to make. But then you get to the critical section. The section that a shocking number of people just gloss over. It's usually titled Settlement Options or Method of Payment, and you'll see a few choices. The first and most prominent is usually lump sum payment. This is exactly what it sounds like. They cut you a check for the full death benefit. $100,000, $500,000, whatever the policy amount is. You take it, you deposit it, and your business with the insurance company is concluded. But right below that, there will be other, more complicated sounding options. And one in particular is the wolf in sheep's clothing. It goes by many names, but it's most commonly called a retained asset account, or sometimes an alliance account, or a secure access account. The description will sound fantastic. It'll say something like, for your convenience, we can deposit the full benefit into a secure, interest-bearing account, and we will provide you with a checkbook so you can access your funds at any time. To a grieving person who doesn't want to deal with the hassle of finding a bank or figuring out what to do with a giant check, this sounds like a godsend. Sounds easy. Sounds helpful. It is for nearly everyone a terrible idea. Let's be very clear about what a retained asset account is. It is not a bank account. It is not FDIC insured. That means if that insurance company, for whatever reason, were to go insolvent tomorrow, your money could be gone. While that's a rare event for major carriers, it's a risk you do not need to take. The FDIC insures your deposits in a real bank up to $250,000. This account has no such protection. What it really is a promise from the insurance company to pay you when you write a check. They hold onto their money in their general fund, and they pay out your drafts as they come in. In the meantime, they are investing that massive pool of money, your money, and the money of thousands of other beneficiaries who chose this option, and they are earning a significant return on it. A return of maybe 6, 7, 8% or more. And what interest rate are they paying you on your money? Usually it's laughably low. It might be 0.5%, maybe 1% if you're lucky. At a time when you could put that same money in a completely safe, FDIC-insured high-yield savings account and earn 4 or 5%, you are effectively lighting money on fire every single day you leave it with them. On a $500,000 policy, the difference between the 1% they might give you and the 5% you could get at a bank is $20,000 a year. That's a car. That's a year of tuition. That's a significant portion of a mortgage. All lost for the illusion of convenience. I worked with a woman, let's call her Susan. Her husband passed away unexpectedly. The policy was for $750,000. She was in a fog of grief, just trying to get through each day. When she saw that retained asset account option, she checked the box without a second thought. It was one less thing to worry about. The insurance company sent her a lovely-looking checkbook. For the first few months it seemed fine. She wrote checks for the funeral to pay off a credit card. But then, about 6 months later, she wanted to use a large chunk of the money to pay off her mortgage. She wrote a check to her mortgage company for $280,000. The check bounced. She called the insurance company, frantic. They informed her that there was a limit on the size of the check she could write, and that for any withdrawal over $50,000, she had to submit a written request and wait for it to be processed. It took her almost 6 weeks and countless phone calls to get that money transferred. 6 weeks of stress, of worrying, on top of everything else she was going through. In that time, she had missed a mortgage payment, and she had lost out on hundreds of dollars in interest she could have been earning in a real bank account. It was a nightmare born from a single uninformed checkmark on a form. The other options you might see are things like annuity or installment payments. An annuity is where the insurance company keeps the lump sum and pays you a guaranteed stream of income for a set period or for the rest of your life. For a very small number of people in specific financial situations, this might make sense. But for the vast majority, it's another trap. You're trading a large sum of money that you control for a smaller stream of payments that they control. You lose flexibility. You can't access the principal if you have a major emergency. And the returns they bake into these annuity calculations are often far less than what you could achieve with a simple, conservative investment strategy on your own. So what is the right answer? For 99.9% of beneficiaries in the United States, the answer is simple, clear, and non-negotiable. You check the box for lump sum payment. You take the entire amount in one check. You walk that check into your bank, a real FDIC-insured bank, and you deposit it into a savings account, preferably a high-yield savings account. From that moment on, the money is yours. It is safe. It is liquid. It is under your control. The insurance company's job is done. They are out of your life forever. Then, and only then, after the money is secure, do you take a breath. You give yourself time. You don't make any sudden moves. You don't buy a new car. You don't give money to that cousin with a great business idea. You sit down with a trusted, fee-only financial advisor to make a plan. A plan for how that money can best serve you and your family for the rest of your lives. Taking the lump sum gives you the power to make that plan. The other options take that power away from you and give it back to the insurance company. Once you've made that critical choice, the rest of the form is about accuracy. You'll need to attach a certified copy of the death certificate. Not a photocopy, an original certified copy. This is why you ordered multiple copies like we talked about. Never ever send your only one. Finally, before you put it in the envelope, make a complete copy of everything. Every single page of the form you filled out, and a copy of the death certificate you're including. Keep this for your records. Then, you will send this package via certified mail with return receipt requested from the U.S. Post Office. This is not optional. This is not a place to save $3. Certified mail creates a legal paper trail. The insurance company has to sign for it, and the post office sends you back a postcard, the return receipt, proving when and who received your claim. If they ever come back and say, "We never got it," you have irrefutable proof. You seal that envelope. You send it off. And now the clock starts ticking. Your part, the hard part of gathering documents and making decisions, is temporarily over. The ball is now in their court. And what the insurance company does in the next 30 to 60 days is a secret world of investigation and verification that most people never see. They are about to put the life of your loved one and your claim under a microscope. And what they're looking for might surprise you. They're looking for a ghost. Not a literal one, of course. They're looking for the ghost of the person who filled out the application. They want to know if that person, the one who answered all those questions about their health, their hobbies, their lifestyle, is the same person who actually lived and died. Because if there's a discrepancy, if there's a mismatch between the application and reality, that's where an approved claim can turn into a denied one. This intense scrutiny almost always happens during a very specific window of time called the contestability period. In most states, this is the first 2 years after the policy was issued. If the insured person passes away within this 2-year window, The insurance company has the right to launch a full-scale investigation into the original application. It's like a probationary period for the policy itself. They essentially press pause on the payment and rewind the tape on your loved one's life, looking for any sign of what they call material misrepresentation. That's the industry term for a lie or omission on the application that, had the company known about it, would have caused them to either charge a higher premium or, more likely, not issue the policy at all. After the 2-year contestability period, the policy becomes incontestable. This means that, with very few exceptions like outright fraud, the company must pay the claim. They can't go back and deny it because they discovered the person was a smoker or had a risky hobby they didn't disclose. The 2-year clock has run out. But inside that window, it's a different world. So, who is actually doing this investigation? It's not just some random clerk in a cubicle. Your claim is assigned to a claims examiner. Think of this person less as a customer service rep and more as a financial detective. Their job is to protect the insurance company from fraudulent claims, and they have a very specific process for doing it. The first thing they do is pull the original application. This document is now Exhibit A. Every answer on it is about to be cross-referenced with the real world. They start with the most obvious document, the death certificate. They're not just looking at the cause of death. They're looking at the details. Were there contributing factors listed? Does the cause of death raise any red flags? For example, if the cause is listed as complications from lung cancer, but the application says non-smoker, that's an immediate giant red flag. If the cause of death was a skydiving accident, but the dangerous hobbies box was left unchecked, that's another. This leads to the suicide clause, a difficult but critical part of this process. Nearly every life insurance policy has one. It states that if the insured dies by suicide within the first 2 years of the policy, the company will not pay the death benefit. Instead, they will typically just refund the premiums that were paid. So if the death certificate is unclear or lists the manner of death as undetermined, the examiner will dig deeper, requesting police reports, autopsy reports, and toxicology results to make a final determination. It's a grim task, but from their perspective, it's a necessary part of enforcing the contract. Next, the examiner becomes a medical historian. They will send out authorization requests, which you, the beneficiary, signed in that initial claim packet, to every doctor, clinic, and hospital your loved one visited, often going back 5 to 10 years before the policy was purchased. They are building a complete medical timeline. They're looking for any diagnosis, any treatment, any consultation that was not disclosed on the application. Did your spouse mention chest pains to their doctor a year before applying for a policy, but write no history of heart trouble on the form? The examiner will find it. Did your parent receive a troubling blood test result but never follow up, and then fail to mention it to the insurance agent? They'll find that too. And they have a powerful tool to help them, the MIB, the Medical Information Bureau. Most people have never heard of it, but it's one of the most important players in this process. The MIB is essentially a credit bureau for your health. It's a non-profit organization funded by hundreds of member insurance companies. When you apply for life, health, or disability insurance, the company can report certain medical information about you to the MIB in the form of codes. If you then apply for another policy with a different company, that new company can query the MIB to see if the information you're providing matches what's already on file. So if your loved one applied for a policy 5 years ago, was coded for high blood pressure, but didn't mention it on this new application, the claims examiner will see that discrepancy instantly. It's a way for insurance companies to talk to each other and catch inconsistencies across the industry. But the investigation doesn't stop at medical records. They'll also check pharmacy records. They can pull a complete history of every prescription your loved one ever filled. This can be even more revealing than a doctor's visit. A prescription for metformin points to undisclosed diabetes. A prescription for an inhaler suggests asthma or COPD. A prescription for an antidepressant could contradict an application that claims no history of mental health treatment. They might even pull a driving record from the DMV. Why? Because a history of DUIs or reckless driving citations indicates a high-risk lifestyle that should have been disclosed and would have resulted in higher premiums or a denial. They are leaving no stone unturned in their quest to verify the information given on that initial application. They are trying to answer one fundamental question. Did we, the insurance company, agree to the right contract based on the right information? Now, this can all sound incredibly invasive and even accusatory. It can feel like the company is actively looking for a reason not to pay. And in a way they are. But it's important to understand the logic behind it. Life insurance is based on a principle of utmost good faith. Both parties are expected to be honest. The applicant must be honest about their risk, and the company must be honest about their promise to pay. The contestability period is the company's mechanism for verifying that good faith. They do this to combat fraud. If people could lie on their applications with no consequences, the system would collapse. Someone who knew they had a terminal illness could buy a massive policy, pay a few premiums, and then leave their family with a multi-million-dollar payout. This would drive the cost of insurance through the roof for everyone else, for all the honest people. So this 2-year investigation, as difficult as it can be for grieving families, is the industry's primary defense against that kind of fraud. So the examiner gathers all this information: the death certificate, the doctor's notes, the hospital records, the MIB report, the pharmacy history, the police report. They compile it all into a single comprehensive file. They place the original application side by side with the reality they've uncovered. They compare every line, every checkbox, every signature. They are looking for a single critical piece of information, that one material misrepresentation that gives them the legal right to deny the claim. After weeks of this silent, intense investigation, the file is complete. The examiner has made their decision. They write up their final report, with a recommendation to their supervisor: pay or deny. And once that recommendation is approved, they pick up the phone. They dial your number. You see the insurance company's name on your caller ID, and your heart starts to pound. This is the moment of truth. And all you can do is hope that you don't hear the 3 words that every beneficiary dreads: "We regret to inform you." But what if you do? What if, after all the waiting, the paperwork, the sleepless nights, the person on the other end of the line clears their throat and utters those exact soul-crushing words: "We regret to inform you that your claim has been denied." The world stops. The air gets thick. It feels like a physical blow, a second loss layered on top of the first. It's not just about the money. It's a profound sense of injustice. The policy was supposed to be a promise, a rock-solid guarantee that in the worst moment of your life, there would be a safety net. And in that single sentence, the insurance company has just told you that the promise was conditional, the guarantee was void, and the safety net has been ripped away. Your grief, already a heavy burden, is now compounded by anger, confusion, and a terrifying sense of helplessness. What did you do wrong? What did they miss? How could this possibly happen? This is the moment where many people give up. They assume the insurance company, with its teams of lawyers and adjusters, must be right. They accept the denial as a final verdict. But that is the single biggest mistake you can make. A denial is not the end of the story. In many cases, it's just the beginning of a fight. And to win that fight, you first need to understand your enemy's strategy. You need to know exactly why an insurance company would deny a life insurance claim in the first place. The number one reason, the one that accounts for a huge percentage of denials, especially in the first couple of years of a policy, is something called material misrepresentation. In simple terms, this means the insurance company believes the person who bought the policy lied about something important on their application. And material is the key word here. Can't be a small, insignificant detail. It has to be a piece of information so important that, had the insurance company known the truth, they either would have charged a much higher premium, or they wouldn't have issued the policy at all. Think about it from their perspective. Life insurance is a calculated risk. They use an applicant's age, health, and lifestyle to predict how long they're likely to live. So what kind of information is material? It's almost always related to health and lifestyle. Did the applicant say they were a non-smoker, but their medical records show they smoked a pack a day for 20 years? That's a material misrepresentation. Did they check no on the box for heart disease, but they had been secretly taking medication for a heart condition for the last 5 years? That's a material misrepresentation. Did they fail to disclose a dangerous hobby, like regular scuba diving or private piloting, or a history of treatment for substance abuse? All of these things dramatically change the insurance company's risk, and if they find out after the fact, they have grounds to deny the claim. This is where a critical concept comes into play: the contestability period. In nearly every state, a life insurance policy has a 2-year contestability period, though it can sometimes be 1 year. This is the insurance company's window of opportunity. If the insured person dies from non-accidental causes within those first 2 years, the company has the right to launch a full-scale investigation into the original application. They will pull every medical record they can find. They'll look at pharmacy reports, hospital visits, and doctor's notes, comparing everything to the answers given on the application. They are specifically looking for that material misrepresentation. They're looking for a reason to say, "You didn't tell us the whole truth, so we don't have to honor our promise." After this 2-year period ends, the policy becomes incontestable. This is a massive shift in power. Now, the insurance company can generally only deny a claim for a handful of reasons, like outright fraud, for instance, if someone else took the medical exam for the applicant. But they can no longer deny it because the applicant forgot to mention they had high blood pressure 5 years ago. The incontestability clause provides a powerful protection for consumers, ensuring that after a certain point, the policy is secure. This is why it's so critical to know when the policy was issued. If the death occurred after that 2-year mark, your position in fighting a denial for misrepresentation becomes infinitely stronger. Of course, not all denials are so complex. Another common reason is much simpler. The policy lapsed. Life insurance is a contract, and the beneficiary side of the contract is to pay the premiums. If those payments stop, the policy will eventually lapse or terminate. Now, it's not immediate. Every policy has a built-in grace period, which is typically 30 or 31 days after a missed payment. If the premium is paid within that grace period, the policy remains in full force. If the insured person dies during that grace period, the claim is still valid. The insurance company will simply deduct the missed premium payment from the death benefit before they pay you. The problem arises when that grace period ends. If the payment isn't made, the policy is canceled. If the death occurs even 1 day after the grace period expires, the insurance company has no obligation to pay. It's a brutal but straightforward contractual reality. Then there are the exclusions. Every life insurance policy has a list of specific circumstances under which it will not pay out. The most well-known of these is the suicide clause. Nearly every policy states that if the insured dies by suicide within the first 2 years of the policy, the company will not pay the death benefit. Instead, they will typically just return the premiums that were paid into the policy. After the 2-year mark, however, a death by suicide is generally covered. Other common exclusions include death that occurs while committing a felony, death from an act of war, or death resulting from an specifically excluded high-risk activity that was outlined in the policy documents. This is why reading the fine print of the policy itself is not just a suggestion. It's an absolute necessity when you're facing a denial. The company's entire argument might hinge on a single sentence buried on page 17. When you receive that denial, it won't be a simple phone call. It will be a formal, detailed letter. This letter is your roadmap. It is the most important document you will receive in this entire process. It will state, in no uncertain terms, that the claim is denied, but it will also be required by law to tell you exactly why. It will cite the specific provision in the policy they are using to justify their decision. It will reference the evidence they've collected, whether it's a doctor's report from 2018 or a specific exclusion clause. And most importantly, it will outline your right to appeal their decision and the process for doing so. Your first instinct will be to panic, to feel defeated. Don't. Your first step is to take a deep breath. Push the emotion aside for a moment and become a detective. Read that letter not once, not twice, but 5 times. Understand their argument. Is it a misrepresentation claim from within the contestability period? Is it a dispute over the cause of death falling under an exclusion? Did they claim the policy lapsed? Every detail matters. This letter isn't a verdict. It's the prosecution's opening statement. They have presented their case against you, and now the ball is in your court. Your job is to find the holes in their argument, to gather your own evidence, and to prepare your rebuttal. They've told you no. But no is not an answer, it's a challenge. And the next step is figuring out how to fight back and turn that no into a yes. So how do you do it? How do you wage this war? It starts with understanding the battlefield. The first stage of this fight is called an internal appeal. Think of it as demanding a rematch, but on their home court with their referee. Yes, the odds feel stacked against you. You are asking the very same company that denied you to review their own decision and admit they were wrong. It sounds almost pointless, doesn't it? But it is a critical, non-negotiable step. In most states and under most policies, you cannot escalate your fight, you can't go to regulators, you can't sue until you have gone through their internal appeal process first. They force you to play their game before you can change the rules. So you play. But you don't play by their unwritten rules of quiet acceptance. You play to win. Your first move is to formally request the entire claim file from the insurance company. Not just the denial letter. Everything. You want the underwriter's notes, the medical consultant's reports, the internal emails, every piece of paper or digital file that led to their decision. You are legally entitled to this. This file is their playbook. It reveals their strategy, their reasoning, and most importantly, their weaknesses. You cannot build a counter-argument until you know exactly what argument you're countering. While you wait for that file to arrive, you become an investigator. Your mission is to build an undeniable mountain of evidence that makes their reason for denial look not just wrong but foolish. Let's break down the common reasons for denial and how you build your arsenal for each one. Was the denial for a material misrepresentation? This is the most common reason. They claim the insured lied or omitted something on their application. A health condition, a smoking habit, a risky hobby. Their denial letter will point to a specific doctor's visit or a piece of information they found. Your job is to dismantle that. First, get all the medical records yourself. Don't rely on what they say the records show. Get them directly from the doctors, the hospitals, the clinics. Read through them. Did the insured really forget to mention a heart condition? Or was it a minor, one-time murmur from 20 years ago that a doctor noted as benign? Was it a pre-existing condition? Or was it a symptom they had that was never actually diagnosed as the condition the insurance company is claiming? You're looking for context. The insurance company strips context away. They find one word, one phrase, and build their entire denial around it. You put the context back in. Maybe you need a letter from the deceased's primary care physician. A letter that states, "Yes, I noted hypertension in his chart, but it was well controlled with medication for 15 years and posed no significant mortality risk. He was, in my professional opinion, in good health for his age." That single paragraph from a medical professional can be a silver bullet that blows a hole right through their argument. Was the denial because of an exclusion in the policy, like a death that occurred during the commission of a felony or a suicide within the first 2 years? Again, you become a fact checker. Don't just accept the police report as the final word. Were there other circumstances? Were there witnesses? In the tragic case of a suicide exclusion, the burden of proof is on them to prove intent. Was there a note? Was there a history of depression? Or could it have been an accident? You need to gather any evidence that introduces doubt into their clean-cut narrative. And here's a pro-level move. You scrutinize the original application. Get a copy of it. Look at the exact questions that were asked. Were they ambiguous? Vague? Could the question "Have you ever been treated for a heart condition?" be reasonably interpreted to mean a major ongoing issue, not a one-off EKG that came back normal a decade ago? If the question is poorly worded, the fault lies with the company that wrote it, not the person who answered it to the best of their ability. You are arguing the spirit of the law, not just the letter. Once you have your evidence, your new medical reports, your expert letters, your witness statements, your analysis of the application, you are ready to draft your appeal letter. This letter is not a plea for sympathy. It is a legal document. It is a structured, logical, and forceful rebuttal of their decision. You start with a clear and simple statement. I am writing to formally appeal the denial of claim number 12345 for the policy of John Smith. This denial, dated October 15th, is based on incorrect information and a misinterpretation of the policy and the facts. Then you go point by point. Use their denial letter as your roadmap. Create headings. If they listed 3 reasons for denial, you create 3 sections in your letter. Section 1. Refutation of material misrepresentation regarding cardiac history. Underneath that heading, you systematically tear their argument apart. You write, your letter states the claim was denied because Mr. Smith failed to disclose a history of heart disease. This is incorrect. As you can see in Exhibit A, the attached letter from his cardiologist, Dr. Evans, the condition you reference was a minor arrhythmia that was fully resolved in 2011 and required no further treatment. Furthermore, in Exhibit B, a copy of the application, you will note that question 12A asks about ongoing treatment for a heart condition, which was not applicable to Mr. Smith. You see the formula? You state their point. You declare it false. You provide the evidence that proves it's false, and you label that evidence as an exhibit. You do this for every single point they made. You are building a case brick by brick with irrefutable proof. You are not emotional. You are factual. You are relentless. You attach every piece of evidence neatly labeled Exhibit A, Exhibit B, Exhibit C. You create a cover sheet listing all the exhibits. You are presenting a professional, organized case file that screams, I am serious and I have done my homework. Your closing paragraph is just as important. It is not. I hope you will reconsider. It is, based on the overwhelming evidence presented, which invalidates each of the points raised in your denial letter. I demand that you reverse your decision and pay the full policy benefit of $250,000 immediately. Failure to do so will be considered an act of bad faith, and I will be forced to pursue all available legal and regulatory remedies. You are drawing a line in the sand. You are telling them that this internal appeal is their chance to make this right. And you are subtly but clearly threatening what comes next if they don't. You send this entire package via certified mail with a return receipt requested. You need a legal record that they received it and when they received it. The paper trail is your best weapon. Then the clock starts ticking. They typically have 30 to 60 days to respond. This is the hardest part. The waiting. It's agonizing. But you've made your move. You fired your shot across their bow. They have 3 possible responses. They can uphold their denial. They can ask for more information. Or they can reverse their decision and pay the claim. If they pay, congratulations, the war is over. You won. But let's be realistic. More often than not, a company determined to deny a claim will simply double down. They will uphold their original decision, often with a boilerplate letter that barely acknowledges the mountain of evidence you just sent them. When that second denial letter arrives, it feels like a punch to the gut. It feels like you've hit a brick wall. But you haven't. You've just completed a necessary step. You played their game on their turf and lost. Now it's time to take the fight to a neutral ground. It's time to escalate, because the internal appeal was just the prerequisite for the real battle to begin. When an insurance company denies your appeal, it feels like they've slammed the final door in your face. They're counting on your exhaustion. They're betting that you'll see that second denial letter, sigh in defeat, and simply give up. They want you to believe that they are the judge, the jury, and the executioner of your claim. But that's a lie. The internal appeal was their process on their terms, judged by their own people. Now you get to change the venue. You get to bring in outside forces they can't control. You have 3 powerful paths of escalation, and we're going to walk through each one, transforming you from a supplicant asking for a favor into a plaintiff demanding what is rightfully yours. Your first and often most effective move is to file a complaint with your state's Department of Insurance, or DOI. Think of the DOI as the government watchdog, the official referee whose entire job is to make sure insurance companies play by the rules. Every single state has one, and these departments have real teeth. Filing a complaint is almost always free, and it can typically be done online through a simple form on their website. This isn't just sending another angry letter into the void. This is fundamentally different. When you file a complaint with the DOI, the insurance company is legally obligated to respond. But this time they aren't responding to you. They are responding to their government regulator, a government body that has the power to fine them, to sanction them, and in extreme cases to revoke their license to do business in the state. Suddenly, your claim isn't just a number in a file. It's a red flag on a regulator's desk. In your complaint, you will lay out the facts just as you did in your appeal letter. But this time, you're telling the story to an impartial and powerful third party. You'll include the policy number, the name of the insured, the date of death, and a clear chronological history of your claim and its denial. You'll attach the denial letters, the appeal letter, and any evidence you submitted. The DOI will then formally open an investigation. They will forward your complaint to a special compliance department within the insurance company, a department that is not in the business of denying claims, but in the business of avoiding government penalties. This single action accomplishes several critical things. First, it forces a fresh set of eyes onto your file, eyes that are concerned with regulatory compliance, not just profit margins. Second, it creates an official government-documented record of your dispute. This can be incredibly valuable later if you need to take further legal action. And third, sometimes this is all it takes. The pressure of a state investigation is often enough to make an insurer reevaluate their position and overturn the denial. They might call it a goodwill gesture or a reconsideration, but you'll know the truth. They folded because they got caught. Don't underestimate this step. It is the most powerful, lowest-cost tool in your arsenal right now. But what if the DOI investigates and still sides with the insurer, or determines that the company didn't violate any specific regulation, even if their decision feels wrong? You're not out of options. You're just moving to the next level of engagement. This is where we enter the world of alternative dispute resolution, or ADR. The 2 most common forms are mediation and arbitration. Mediation is a structured negotiation. You and a representative from the insurance company sit down with a neutral third party, the mediator, whose job is to help you find common ground and reach a settlement. The mediator doesn't make a decision or force anyone to agree. They are a facilitator. This can be a faster and far less expensive way to resolve a dispute than going to court. It's an opportunity to have a frank, off-the-record conversation and see if a deal can be struck. Your attorney might present the weaknesses in their denial. They might present the perceived weaknesses in your claim, and the mediator will work to bridge the gap. Arbitration, on the other hand, is more like a private court. An arbitrator or a panel of arbitrators will hear evidence from both sides and then render a legally binding decision. Some insurance policies actually have mandatory arbitration clauses, meaning you are required to use this process instead of filing a lawsuit. It's crucial to read your policy to see if this applies. While it's generally faster and less formal than a court trial, the decision is usually final, with very limited grounds for appeal. For both mediation and arbitration, this is no longer a do-it-yourself project. You need an experienced attorney by your side. You are now officially in a legal proceeding, and showing up without professional representation is like walking into a sword fight with a butter knife. This brings us to the third and most formidable path of escalation: filing a lawsuit. This is the ultimate showdown. This is where you take the insurance company to court and ask a judge and jury to compel them to pay the claim. When you sue a life insurance company, your lawsuit will typically be built on one of two foundational legal arguments: breach of contract and the far more serious charge of insurance bad faith. Breach of contract is the most straightforward claim. A life insurance policy is a legally binding contract. Your loved one paid their premiums, fulfilling their end of the bargain. The insurance company, by denying the claim without a valid reason, has breached that contract. In a breach of contract lawsuit, you are asking the court to enforce the terms of the agreement and award you the death benefit you are owed, plus interest. It's a direct, powerful argument. You made a promise. You broke it. Pay up. But then there's bad faith. An insurance bad faith claim is a different animal altogether. This goes beyond simply being wrong. This is an accusation that the insurance company acted unreasonably, unfairly, or dishonestly when it denied your claim. It's not just that they breached the contract, it's that they had no reasonable basis for doing so. They knew or should have known that the claim was valid, but they denied it anyway. Examples of bad faith include denying a claim without conducting a proper investigation, intentionally misinterpreting the language in their own policy, using deceptive practices to trick you into dropping your claim, or creating unreasonable delays to wear you down. Proving bad faith is more difficult than proving a simple breach of contract, but the consequences for the insurance company are infinitely more severe. And here's why that matters so much. If you win a breach of contract case, you get the policy benefit. But if you can prove bad faith, you can be awarded not only the policy benefit, but also damages for emotional distress, attorney's fees, and, this is the crucial part, punitive damages. Punitive damages are not designed to compensate you for your loss. They are designed to punish the insurance company for their egregious behavior and to deter them and other companies from ever doing it again. These awards can be multiples of the original policy amount, sometimes running into the millions of dollars. The threat of a bad faith lawsuit is the single greatest point of leverage you have. It changes the entire financial calculus for the insurance company. Suddenly, the cost of fighting you and losing becomes astronomically higher than the cost of simply paying the claim. This is why, from the moment your appeal is denied, your next call must be to a lawyer. Not just any lawyer, but a specialist, an attorney who focuses specifically on insurance bad faith litigation. They know the tactics, they know the law, and most importantly, they work on what's called a contingency fee basis. This means you pay them nothing up front. They only get paid a percentage of the money if and when they win your case. This levels the playing field completely. The insurance company has an army of lawyers on retainer. A contingency fee attorney becomes your own personal legal champion, funded by the very settlement you're fighting for. They take on all the risk. So let's be clear about where you are now. The internal appeal is over. The time for polite letters is done. You have a playbook for escalation. You can bring in the state regulators. You can force a negotiation through mediation. And if all else fails, you can bring the full weight of the justice system down upon them with a lawsuit, accusing them of not just being wrong, but of acting in bad faith. You are no longer just a beneficiary. You are a potential plaintiff with the power to hold them accountable in a court of law. You now have the playbook. You know the moves. But to win the game, you need the right player on your team. And finding that champion is the single most important decision you will make. So how do you find this champion? How do you separate the legal eagles from the ambulance chasers? This isn't like picking a plumber from the phone book. This is a talent search for the one person who will stand between your family and a corporate giant determined to keep what is rightfully yours. Most people start with a Google search. They type in life insurance lawyer near me and pick one of the first 3 names that pop up. This is, without a doubt, the single fastest way to lose your case before it even begins. Those top results are often just the law firms with the biggest marketing budgets, not the ones with the sharpest minds or the best track records. You'll see smiling faces on billboards, promising quick cash and easy settlements. These are generalists. They're the jack of all trades, master of none attorneys who might handle a car wreck on Monday, a divorce on Tuesday, and your complex ERISA-governed life insurance appeal on Wednesday. You cannot afford a generalist. You wouldn't ask your family doctor to perform open heart surgery. So why would you ask a general personal injury lawyer to navigate the labyrinth of federal insurance law? You need a specialist, a super specialist. You need the legal equivalent of a Navy SEAL, someone who trains for one specific mission, who knows the terrain blindfolded, and who has faced your exact enemy 100 times before and won. These lawyers exist, but they don't always advertise on daytime television. Their reputation is built in courtrooms and in the hushed conversations of other attorneys, not on splashy websites. So, your mission, should you choose to accept it, is to conduct an investigation. You are now the hiring manager for the most important job in your family's life. You need to be ruthless, you need to be methodical, and you need to ask the tough questions. Here is your operational blueprint for finding and vetting the right attorney. First, where do you even look? Start with your state's bar association. They often have a referral service that can filter for attorneys who specialize in insurance law, specifically bad faith insurance litigation or ERISA claims. This is a much better starting point than a random search engine. Another powerful and often overlooked resource is other lawyers. If you know an attorney, even one who practices in a completely different field like real estate or criminal law, ask them for a referral. The legal community is small. Good lawyers know other good lawyers, and more importantly, they know who has the reputation for being a shark in this specific niche area of the law. Once you have a short list of 2 or 3 potential champions, the real work begins. You must schedule a consultation. Most, if not all, credible attorneys in this field will offer a free initial consultation. Do not think of this as a sales pitch. Think of it as an interrogation. You are there to grill them, to test their knowledge, and to gauge their commitment. You hold all the power in this meeting. Here are the 5 critical questions you must ask, and you cannot be afraid to ask them directly. Question number 1. What exact percentage of your law practice is dedicated to handling denied life insurance claims? Listen carefully to the answer. If they hesitate, if they say, "Oh, we handle all sorts of personal injury and insurance stuff," that's a red flag. You're looking for an answer like 75% or more. Or even better, "It's all we do." You want the lawyer who eats, sleeps, and breathes this specific type of injustice. Question number 2. How many cases have you specifically handled against my insurance company? This is a killer question. An experienced lawyer will have a history with the major players: Prudential, MetLife, Lincoln Financial, Unum. They know the tactics, the arguments, and the specific lawyers the insurance company will use against you. If they can say, yes, we just settled a case against them last quarter for a client in a similar situation," you know you're talking to a veteran. If they say, "Well, we're familiar with them," that's not good enough. You want familiarity that comes from battle, not from reading a brochure. Question number 3. Walk me through your fee structure. Do you work on a contingency fee basis? This is non-negotiable. The answer must be yes. A contingency fee means the lawyer only gets paid if they win your case. They take a percentage of the settlement or verdict, typically between 30 and 40%. This is incredibly important for 2 reasons. First, it means you don't have to pay a dime out of your own pocket to get world-class legal representation. The lawsuit is financed by the law firm. Second, and more importantly, it aligns their interests perfectly with yours. They are not getting paid by the hour to drag things out. They have one incentive and one incentive only: to get you the most money as quickly as possible. If they win, you both win. If they lose, they get nothing. It's the ultimate proof that they believe in your case. Be sure to ask about costs as well. Things like filing fees, expert witness fees, and deposition costs. A reputable firm will often cover these costs up front and then deduct them from the final settlement. Get this in writing. Question number 4. Who specifically will be the primary attorney handling my case? This is the bait and switch detector. You might have your consultation with the senior partner, the big name on the letterhead, but once you sign the paperwork, your case gets handed off to a brand new associate who is still learning the ropes. You have the right to know who your point of contact will be, who will be in the trenches with you. Ask to meet them. It's perfectly acceptable to say, "I appreciate your time, but before I make a decision, I'd like to have a brief conversation with the associate who will be managing the day-to-day aspects of my file." Their reaction to this request will tell you everything you need to know about the firm's culture. And finally, question number 5, the ultimate test. Based on what you've heard so far, what is your initial assessment and proposed strategy for my case? A true expert will be able to give you a preliminary roadmap right then and there. They won't make wild promises or guarantee a result. In fact, any lawyer who guarantees a win is a lawyer you should run from. But they should be able to say something like, "Okay, based on this policy exclusion they're citing, our first step will be to file an aggressive administrative appeal under ERISA. We'll hire a cardiologist to write a rebuttal medical report, we'll get sworn affidavits from these 3 witnesses, and we'll hit them with a demand for the entire administrative record within 30 days. If they don't reverse their decision at the appeal stage, we'll be prepared to file a federal lawsuit immediately." That is the voice of a confident, experienced strategist. That is the voice of a champion. Beyond these questions, you must trust your gut. This person is going to be your partner in one of the most stressful fights of your life. Do you feel heard? Do they treat you with respect and empathy? Or do you feel like just another number? Another file on a cluttered desk? Communication is everything. If they are slow to return your call for the initial consultation, imagine how hard it will be to get them on the phone when your case is in full swing. You are not just hiring a lawyer. You are entrusting someone with your family's financial future, with the legacy your loved one intended to leave. This decision is the fulcrum upon which your entire case will turn. Take your time. Do your homework. Conduct your interrogation. Find the specialist, the veteran, the one who knows the enemy and isn't afraid to fight. Because once you have that champion in your corner, the entire dynamic shifts. You are no longer a victim begging for scraps. You are a formidable opponent, armed with expertise and ready for battle. The insurance company knows this. Their entire calculus changes the moment your lawyer's name appears on the letterhead. You've found your champion. You've signed the agreement. You've handed over the mountain of paperwork. For the first time in months, you feel a glimmer of hope. But what happens next? What does the first move in this high-stakes chess match actually look like? Now that the team is assembled, the war is about to begin. The first move is not a dramatic courtroom showdown. It's a quiet, calculated act of aggression. Your attorney drafts what's called a demand letter. This isn't a polite request. It is a formal legal document that lands on the desk of the insurance company's in-house counsel with the force of a battering ram. It lays out the facts in cold, hard detail. The policyholder's name, the policy number, the date of death, and the amount of the benefit. Then, it meticulously deconstructs the company's denial. Every flimsy reason they gave you is addressed and systematically dismantled with legal precedent and contractual obligations. The letter cites specific state insurance codes the company may have violated. It attaches crucial evidence, the death certificate, medical records, anything that proves your claim is valid. And it ends with a clear, unambiguous ultimatum. Pay the full policy benefit within a specified time frame, typically 30 days, or a lawsuit will be filed. This letter is a signal. It tells the insurance company that you are no longer a grieving, confused individual they can push around. You are now represented by a professional who knows their playbook, speaks their language, and is prepared to escalate. The ball is now in their court. The massive, faceless corporation has to respond, and their response will tell you everything you need to know about the fight ahead. Sometimes they resort to their old tricks. They might send a letter requesting more information, a classic delay tactic designed to bleed your resources and your will to fight. They'll ask for records they already have, or for documents that are completely irrelevant, hoping to bury your attorney in a new avalanche of paperwork. A seasoned lawyer sees right through this. They will provide what is reasonable and legally required, but they will also send a firm response stating that all necessary documentation has been provided and the clock on the demand is still ticking. Another common response is a formal reiteration of their denial. This time, it's a letter from their legal department to your legal department. It's more detailed, more couched in legal jargon, but it's the same no. This isn't a setback. It's an expected move. They are testing your resolve. They are showing you they won't fold at the first sign of pressure. This is where the real psychological warfare begins. But the most telling response, and the one that signals a potential path to victory without a full-blown war, is an offer to talk. They won't admit fault. They won't apologize. But a senior claims adjuster or one of their lawyers will call your attorney and say, "Let's discuss this." This is the beginning of the negotiation. This phase is a high-stakes poker game. Your lawyer has a strong hand. The facts, the law, and the threat of a costly lawsuit. The insurance company has a massive stack of chips. Billions of dollars and a team of lawyers paid to minimize losses. The initial settlement offer they make will almost certainly be insulting. It'll be a fraction of the policy's value. A lowball number thrown out to see if you're desperate enough to take it and go away. Your lawyer will reject it immediately. Then the real dance begins. Your attorney will present the strengths of your case, highlighting the weaknesses in their denial. They'll talk about the costs of litigation, the tens or even hundreds of thousands of dollars the company will spend on legal fees defending a losing case. They'll mention the risk of a jury, which can be unpredictable and often sympathetic to a grieving family. The insurance company's lawyer will counter, pointing to any potential ambiguity in the policy or any piece of information they can twist to their advantage. Offers and counteroffers are exchanged over weeks, sometimes months. Each phone call, each email is a calculated move. The insurance company is betting that the emotional and financial strain will wear you down. Your lawyer is betting that the company's cold, hard business calculation will lead them to one conclusion. Settling is cheaper and safer than fighting. But what if they refuse to be reasonable? What if their offers remain laughably low and they continue to stonewall? Then your attorney presses the big red button. They file a lawsuit. The moment that complaint is filed with the court, the entire dynamic shifts. The dispute is no longer a private matter between you and the company. It is now a public record overseen by a judge. The company can no longer control the flow of information. They are now subject to the rules of civil procedure, and the most powerful of these is discovery. Discovery is the legal process where both sides are forced to show their cards. Your lawyer can now demand internal documents from the insurance company, emails between adjusters, training manuals, company memos about claims handling, and the entire unedited file on your specific claim. They can force the very adjuster who denied your claim, and their supervisors, to sit for a deposition. A formal videotaped interview under oath where they must answer every question your lawyer asks. This is the insurance company's worst nightmare. It's where bad faith is often uncovered. Did the adjuster spend only 10 minutes reviewing your file before issuing a denial? Was there pressure from management to deny claims over a certain dollar amount? Did they ignore evidence that supported your claim? These are the questions that can be answered in discovery, and if the answers are bad for the company, their leverage evaporates. This is where we must talk about the ultimate weapon in your arsenal: a bad faith claim. In the United States, insurance companies have a legal duty to act in good faith and fair dealing with their policyholders. This means they can't just deny a claim for a frivolous reason. They must conduct a thorough, fair, and objective investigation. If they deny a claim without a reasonable basis, or if they knowingly put their own financial interests ahead of their obligation to you, they can be sued for bad faith. A bad faith lawsuit is devastating for an insurance company, because if you win, you are entitled to not just the original life insurance benefit, but also extra contractual damages. This can include all of your attorney's fees, money for the emotional distress they caused you, and in the most egregious cases, massive punitive damages. Punitive damages aren't about compensating you. They are designed to punish the company and deter them from ever treating another family the same way again. The mere threat of a credible bad faith claim is often enough to bring even the most stubborn insurance company to the negotiating table with a serious settlement offer. This is why over 95% of these lawsuits never actually go to trial. A public trial is a massive risk for the insurance company. It's incredibly expensive, it's a public relations disaster, and a jury of 12 ordinary citizens could hit them with a verdict that dwarfs the original policy amount. It's a business decision. They run the numbers, they assess the risk, and in the vast majority of cases they decide to settle. The settlement negotiation at this stage is far more serious. The lowball offers are gone. The company's goal is now to make the problem go away as efficiently as possible. Your lawyer will negotiate a final number that is fair and just. An agreement is drafted, you sign it, and the legal battle is over. Then one day a check arrives. It's not just a piece of paper. It's a symbol of everything you've endured. It's the fulfillment of a promise made years ago by someone you loved. It's the resource they intended for you to have, to provide security, to pay for a home, to fund an education, to give you breathing room in a world that has been turned upside down. It is validation. It is justice. The journey from that first devastating phone call to this moment is a trial by fire. It tests your patience, your finances, and your emotional fortitude. It forces you to navigate a complex system deliberately designed to be intimidating. But it is a journey that can be won. This entire process, from filing the initial claim to cashing the final check, is a testament to the fact that you do not have to accept an unjust no. You have rights, and there is a path to enforce them. It is about honoring a legacy and holding a powerful industry accountable to its most sacred promise. And that is a fight worth fighting.